What is going on, guys? My name is Tyler. I hope you guys are doing well, and I'm glad you could join me today. First things first, I gotta bug you guys with the request that you hit the like button, hit the subscribe. According to my YouTube analytics, only 11% of you guys are subscribed, so that's a problem. I can help your portfolios out. All right, guys, I think I'm ready to get into this video. I had to get some coffee in me, so I'm using my favorite mug. Keep calm. I'm your realtor, so you guys keep calm. Let's get into it. So guys, like the title of this video says, you can make $100 a day or $100 a week, more or less, depending on a couple things: the size of your account, how active you actually want to be with it, because you can do it a total passive strategy. But with my situation, I don't play this strategy passively, because if you play it passively, you give up some of the profits, because you don't want to get into a situation and then be totally blind to it and then end up losing the full amount that you could, because this is a defined risk strategy. So once you open a trade, you can only lose so much, and you can also only gain so much. So it is defined, but the percentage is about 85 to 90% of the time this strategy will work and you will make money. That's where it works for me though, because I'm active with it. So if a trade does start to go against me, that 10 to 15% of the time, it rarely ever does. 10 to 15% of the time is pretty low chance, but when it does, you can minimize your losses and get out quickly. So it is a very profitable strategy. The two strategies we're going to be talking about is selling premium, selling cash secured puts, and credit spreads. Most of you guys will probably be doing credit spreads just because it is a cheaper cost of entry to get into these plays, and you profit from the stock not really doing too much. If the stock is flatlined, just not doing nothing, then that's the ideal situation for credit spreads, because you're playing theta. If you don't know what theta is how much a contract will go down or up in value every single day closer to the expiration day. So that is important to know. It's not really a necessity. You more or less have to know how the company moves and watch out for news events and stuff like that can greatly influence the price, because with credit spreads, you want the price to be the same. Now, with selling premium, selling puts, obviously if you're selling the put, you would want the stock to go up. If the stock just stayed flat, then you would still make money. You just wouldn't want the stock to go down. I just want to clarify that cash secured puts, when you sell them, it is not a defined risk, kind of, because you're agreeing to put up the money necessary if you had to. If the stock was under your strike price at the time of expiration, you put up money for 100 shares, so you would have to buy it. If, let's say, you had sold this $56 put, right, for January 22nd on NEO. If the stock closed at 55.50 or whatever, look, you'd lose basically the difference, because the stock would be at 55.50 and you bought this at 56. So you essentially would have to buy the shares at 56, so your cost average would be 56, and then there's a 50-cent spread between the two. So really, if NEO dropped to $50, you would still be forced to buy them at $56. The way I like to play this strategy, right? First things first, you do not want to buy or sell, I should say, a put on a company that you do not want to own, or you wouldn't feel comfortable owning. You don't want to sell that. It goes wrong. It goes against you, and then you have to buy the shares and then instantly sell those for a loss. That's no good all around. So you want a company, one, that you would feel comfortable holding. Maybe it's already in your portfolio. Secondly, I only do this on stocks that move a lot, that have a high premium, like BigCommerce. It's in my long-term holdings, quite a bit of it. I have about $4,000 invested with BigCommerce. It is a small cap company. It's a $4 billion market cap company. So the stock price moves a lot. It's at $62.20. So effectively, if I sold the $55 call and collected $318, look, minimum credit $318, I would have to put up $5,500. So however low the stock went, if it went under $55, then you would be forced to buy the shares, right? But you would have received it $318, so your cost basis would be $51.82. So that is worst case scenario, that the stock just keeps falling under that, and you're stuck with a cost basis at $51.82. But you don't want that to happen. You want, obviously, BigCommerce to go up if you were selling the put, so it would make this put less valuable. And then to close it out, you're selling the contract. To close it out, let's say it went to 200, you would go buy and then sell, or buy it for $200, and then you'd be out of the trade. You would have made $100. And see, that could quite possibly do it in one day. That's for sure. But I don't always want to hold these all the way till expiration. Typically, I like to hold the put that I sold for a couple days to get a big swing in either direction, because the contracts with high IV lose value quickly and gain value quickly. So I'm playing off that momentum. But let's say you were to just let this contract go all the way to the expiration date, it would start to lose value very fast, like with the theta. I'm going to show that on screen again so you guys remember. The closer to expiration, that's where you get the big moves at. So with that being said, most of you guys will probably be doing credit spreads. Some of you guys will be doing this if you have bigger accounts, but it mostly be credit spreads. But you would keep the whole amount if it went all the way to expiration. You would keep the $318. But let's get into what you guys would probably be doing on a regular basis that I do more often myself, because it is a cheaper cost to entry with a little bit more risk to reward, but it is defined risk. So when it comes to credit spreads, guys, there's a couple things I look for and is a necessity when it comes to doing a credit spread. That is, I do not want a company or a stock that moves a lot, because you make money if it doesn't move at all. Because you can do a call credit spread and a put credit spread, because you're selling the spread, and I don't want to go too deep into that right now. But so you do not want it to move a lot. If the company stays the same, that's where you make the full amount, is if the contracts expire worthless. You want them to expire out the money. So with that being said, the next thing I need is volume and a tight bid to ask. So it's not too hard to get filled, and if you had to get out of it, it's not too hard to get filled, and you wouldn't have to take a bad fill. So jumping on over to the example of a credit spread. This is a call credit spread. You can see it's on AMD, call, and it's on the buy, expiring January 22nd. So this next week out. And remember, we are closed Monday. We are not trading Monday, so it is a short week. Keep that in mind. That might help the premiums, right? So look, you always want to sell one that is more expensive and buy a cheaper one, so you would get a credit. So me personally, since these are like 93.5 and then 94, that is times 100 the difference. So that's $50. So 50 cents equals $50. A dollar difference, 93 to 94, equals $100. So look, me personally, I don't see AMD hitting $94 personally, and I'm willing to spend $100 per contract. So I would sell this one at 51, and then I would buy this one at 55, and that is a total credit of $12. So if you did, let's say, 5 of them, type in 5 right here for number of contracts, and that would be $60. That's what you would receive up front. If AMD closed under $94 by next week, by next Friday, you would make $60 guaranteed, and that is putting up $500 collateral if things were to not work out that way and AMD were to close above $94. So with that being said, you could do 10 contracts, which would be $1,000, and that is $120. Go ahead and show you guys how to do a put credit spread. Basically the same thing. It is the same thing. It's just a little bit weirder how you have to do it, if that's a word. Excuse me if it's not. But so I'm going to show you how to do that, right? So you'd still want to sell a more expensive one and then buy a cheaper one because you're trying to get a credit. So if you go right here to sell this one, sell the $85 one, buy the $84 one. So you would want AMD to close above $85. I would probably go down another one. So that's what I'm gonna do for you guys. I'm not gonna demonstrate one that I would not do myself. So you'd sell this one. I always like to sell the first one. I don't know, it's just my preference. So I would sell this one, and then I would buy this one, which is $10. So then you do 5, and that would be $50, right? For 5 contracts at $10 a piece, $50, $500 collateral. So that is 10% on your money. But see, you can get creative, like with the first one I showed you guys. Go back to that real quick. Just moving up one strike price. You go sell this one, and then buy this one, $23. You put up 5 at $500, 5 contracts, it'd be $115 you'd get back. So that is a little low. That's about 22% if I'm correct on the math. So that is really, really good. And if AMD were to go up, that's where you could close out the spread, because the spread would tighten because the expiration date is coming closer. So the spread would tighten, and then you could sell out for a good profit, or you could hold it and let it expire and keep the whole profit. So I think that's all you guys need to know to do this strategy, and that's the core of it. There's a lot I could keep mumbling on about and talking about. There's so many different little strategies and things I like to use, like with the Greeks and delta, gamma, theta, all those. Make a separate video on that. But if you guys like the content, if you guys are going to implement it, or maybe you guys already do, I would like to know your feedback on what companies you guys like to do credit spreads on, put credit spreads, debt, call credit spreads, all that good stuff. So if you don't mind, hit me with a comment down below on that information, and hit me with a subscribe if you have not already. Like I said, it is free 99. And if you guys enjoyed the video, hit me with a like too. That's all I got for you guys. So until next time, guys, peace out.